Hello and welcome back to Brickonomics, the business of building. I'm your host, Nick Scroggs, and today I want to start this episode with something that might sound a little strange coming from me. If you've listened to any of the previous episodes of the podcast, you may know that I have two master's degrees. One, which is an MBA with a concentration in finance, and the other, which is a master's degree in construction management. By most measures, I came into this business more financially educated than the average person starting a construction company, and yet I still got many of the things we're going to talk about today wrong. Not because the education that I got was useless, and not because I didn't understand what a P&L or balance sheet was, but because there's a massive difference between understanding finance in the classroom and actually being able to read your own company's financials in a way that changes the way that you operate. That gap, the space between financial literacy and financial clarity, is what this episode is about. Because I think that a lot of builders avoid this topic because they assume that it requires an accounting background that they simply don't have. And I understand that instinct, but what I've learned is that the problem usually isn't a lack of education. The problem is that the data feeding into your financial systems is broken. And broken data produces a broken picture, no matter how well you understand the reports that are sitting on top of it. You can be looking at a P&L that's technically accurate and still completely misreading your business, not because you're bad at numbers, but because the numbers are only reflecting what went into them. And if what went into them was wrong, the output is going to be wrong as well. That was us. And the moment that I figured that out, everything changed. So today we're going to talk about how I actually learned to read our financials, not in theory, but in practice. We're going to talk about the specific ways that our data was broken, what it was hiding from us, and what we did to fix that. And I'm going to give you a set of red flags, real diagnostic signals that you can use to check whether the financial picture is telling you the truth. In our first year in business, we did around $1 million in revenue. In our second year, we did around $2 million. In our third year, we did around $4 million. And when you're growing that fast, it's very easy to think that things are working. The phone is ringing, you're hiring people, and you're moving into a bigger space. And from the outside, it looks like success. And in many ways, it is. But what started happening to us around that third year when we crossed the $4 million mark is that things started to get tight. There was always money moving, but we kept finding ourselves in these moments where cash was thinner than it should have been relative to the amount of revenue that we had under contract. And I remember that feeling pretty clearly because I would look at the bank account, and if the number looked healthy, I felt okay. And if it looked lean, I would feel pressure. That was my primary financial dashboard, but the problem is that that's not financial management. That's an emotional reaction to a number on the screen. The bank balance has almost no context. It doesn't tell you what's already been committed against that number. It doesn't tell you whether the cash is truly available or whether it's already spoken for multiple times over by upcoming payroll, vendor payments, and material deposits. It also doesn't tell you whether you're looking at a real cushion or just temporary custody of money that's about to flow right back out. In construction especially, this is dangerous because you get large cash inflows. A client deposit lands, a draw releases, a vendor payment hits, and suddenly the account looks very strong. You feel good. You make decisions based on that feeling, and then 2 weeks later, all of that money is gone because it was never really available in the first place. Here's what I know now that I didn't fully internalize then. Revenue is not profit, and profit is not cash. These are completely different things, and they can tell you completely different stories about your business all at the same time. Revenue is what you've sold. Profit is what you keep after your expenses, and cash is what's actually available to you right now. A business can look strong on all three of those and still be fragile, but more commonly, you'll see a business that looks strong on revenue, looks decent on profit, and is quietly suffocating on cash because the timing between spending and collecting is working against it. That's the trap, and almost every builder that I've talked to has lived this at some point. The first flag to look for here is if your primary indicator of financial health is the bank balance and you feel noticeably better or worse on whether a deposit just hit, you're managing by emotion, not by data. And that's the first sign that the system needs work. As we started growing, we were using accounting software to manage our books. We also had an outside CPA who reviewed things for us at the end of the year and help us out with our taxes. On the surface, that sounds like a very reasonable setup, but there was a problem that we didn't see for quite some time. Our data was wrong. Not fraudulently wrong, not intentionally wrong, just quietly and structurally wrong in a way that made our financials look different than our reality. So here's the specific issue. When a client paid us a deposit at the start of a project, we were recording it as revenue. And that sounds logical on the surface, especially when your accounting software makes it incredibly difficult to record client deposits in any other way. Money came in, so we recorded income. But that's not how it works. A deposit is not revenue. A deposit is a liability. It's money that a client has given you in advance of work that you haven't performed yet, so you haven't earned it. You still owe them that work, and until that work is done, that money belongs in a liability account, not in your income. What this was doing to our financials was inflating our revenue in the months when deposits came in, and it made our income look higher than it actually was based on the completed work. And here's the practical consequence that hurt us the most directly. We were paying taxes on money we hadn't earned yet. Think about that. We were writing checks to the IRS on revenue that hadn't been realized, and that's a real cash drain on money when you're supposed to be still holding it as a liability against future project costs. The part that made me most uncomfortable when I realized it, our CPA wasn't the one to catch it. Not because they were negligent, but because they were working with data that we had given them. They looked at our books and they saw revenue recorded in a certain way, and so they processed it accordingly. They had no reason to question whether the classification was right because on paper, it looked consistent. That was a formative lesson for me. Your accountant only knows what you tell them, and even a great CPA can't fix problems that they can't see, so if your books are feeding them the wrong inputs, their outputs will be wrong as well. The sophistication of the advisor doesn't matter if the underlying data is broken. Once we fixed the deposit classification, moving them out of revenue and into customer deposits liability accounts, the balance sheet started telling a completely different story. Suddenly, we could see clearly what we had actually earned versus what we were holding in a trust for future work, and the P&L reflected reality instead of inflated timing. Additionally, our tax liability was more accurately reflected in our actual income. The red flag to watch for here? Pull up your balance sheet right now and look at your liabilities section. Do you see a customer deposits account? If you're receiving deposits on a project and that account doesn't exist or is always empty, your revenue may be overstated. That money is not yours yet, and treating it like it is creates a false picture of both income and tax liability. A second red flag? If your revenue looks strong on your P&L, but your cash feels chronically tighter than the numbers suggest, the first place to investigate is whether deposits are being classified correctly. Inflated revenue masks the true cash position of any business. The second major problem that we ran into was on the other side of the ledger. If the deposit issue was about money coming in being misclassified, this one was about money going out that was invisible. Here's how our process worked in the early days. We would bid work out to subcontractors and vendors, they would do the work, and then when they felt like it, they would send us a bill. That last part sounds small, but it wasn't, because subcontractors and vendors, and I say this with genuine affection for the people that we work with, are often terrible at collecting their own money. They get busy, they move on to the next job, they finish the work on your project in October, and don't get around to invoicing you until late February. And when February comes around and they've run out of cash on some other project, suddenly they realize they have 6 months of unbilled work sitting out there that they need payment on right now. So they put together a single invoice for everything. $50,000, $60,000, sometimes $100,000, and they need it paid immediately. I've had this exact same conversation more times than I can count. A subcontractor calls, clearly under pressure, and presents a bill that covers work that we completed months earlier. Work that, from our perspective, was long since finished, and now we're staring at a six-figure payable we weren't planning for. The problem isn't just the surprise payment. The problem is what it does to your financial picture in real time. If those payables aren't entered into your system until the subcontractor decides to bill you, your accounts payable balance is always understated. You think that you owe less money than you do, so your projected cash position looks better than it is. And when the bills finally hit, It looks like an expense spike when in reality, it's just delayed recognition of work that you committed to months ago. The fix came to us in two parts. First, we implemented purchase orders for everything. When we awarded work to a subcontractor or vendor, we issued a PO that defined exactly what they were going to be paid and exactly what the scope was. This created a record of the commitment on our side before the work even started, and critically, it gave us the basis for a new payables entry. We now knew what had been committed to spend so that we could account for it even before the invoice had arrived. Second, we built a payment schedule and tied it to the construction calendar. Instead of waiting on subcontractors to invoice us whenever they felt like it, we built billing milestones directly into project schedules so that when the phase of work was complete, a billing trigger was fired. The sub was then expected to invoice against that trigger, and even when they didn't, we would go ahead and push payment because on our end, we were prepared to pay it as it was tied to a schedule item that we were actively tracking. What this did to our financial visibility was significant. Our accounts payable balance started actually reflecting our real obligations instead of only the bills that had already arrived. We could project our payables weeks and months in advance based on where projects were in the schedule. Cash flow planning became something that we could do with reasonable accuracy instead of constantly being ambushed by invoices that we forgot were coming. We also changed our payment terms. We moved away from paying on invoice, which in practice means paying whenever somebody gets around to billing you, and shifted to a net 15 term. So subcontractors and vendors now bill us when the work is complete, and we pay them within 15 days. That 15-day window does a few important things for us. It gives us time to verify that the work was actually completed before writing a check. It also gives us the invoice time to move through our approval and accounting process, and it gives us a predictable payment window that we can plan around instead of being reactive. The first red flag to watch for here, look at your accounts payable aging report. If your payables regularly spike in ways that don't correspond to project activity, or if you're seeing large invoices that feel like surprises, you probably don't have a PO system creating that liability up front. The commitment existed, the financial record did not. The second red flag, if you can't tell me today within reasonable accuracy what you expect to pay out over the next 60 days across all active projects, your payables are invisible. That's not a bookkeeping quirk. That's a cash planning crisis waiting to happen. Once we cleaned up how deposits were classified and started getting real visibility into our payables, a third problem became very clear. We weren't taking enough money up front. Now, if you've been in construction for any amount of time, you've probably heard some version of 10% deposit is the industry standard. And I understood where that came from because 10% is roughly your margin on a typical project, so you're essentially getting your profit upfront as protection. But that framework was built for a very different kind of operation than what we're running today. A typical remodeler or new home builder using mostly subcontractors has a very different cash exposure profile than we do. Their major cost items, framing, mechanical, electrical, plumbing, all are on terms. The sub does the work, submits the bill, and then sometime after that, you pay them back. Your cash doesn't go out until well after the work is done, and so the client has likely already paid a draw. Our business model is very different. We have in-house designers, we have in-house construction management staff, we have in-house crews, which means a significant portion of our cost structure is happening on payroll, biweekly, regardless of whether the client has paid anything yet. I have to make payroll every 2 weeks, whether or not a draw has released, whether or not a client has sent a check, or whether or not anything else is flowing in. On top of that, we're often required to put large deposits down on things like material packages, appliances, cabinetry, countertops, and windows well before those items are installed or before a corresponding draw is due from the client. So that cash goes out early. So when I actually started mapping out our actual peak cash exposure on any given project, meaning the maximum amount of money that we would have out the door before the reimbursement came back in, 10% wasn't even close to enough to cover it. When you're running one project, that gap is manageable. When you multiply it across 8 or 10 active projects, you're financing a significant portion of your client's construction costs, whether or not you realize it. And if you're doing it on a 10% deposit, you're doing it on borrowed time. We landed at around 25% deposit. That was the number that when we modeled out our cash exposure on a typical project with payroll, commitments, material deposits, and early phase subcontractor costs, it actually covered our peak outflow before the first major draw came back in. And here's the thing that I want to tell every builder who's nervous about asking for a larger deposit. We also thought that it was going to be a problem. We genuinely expected pushback. We expected clients to balk, to shop us against other competitors, and to use it as a negotiation lever. It wasn't a problem. Not only did clients accept it without significant resistance, but the ones who weren't willing to put down 25% told us something important about themselves before we ever even signed a contract. A client who won't commit to a meaningful deposit up front is often a client who hasn't made the financial arrangements that they need to actually execute the project. And that client down the line becomes the client who disputes draws, delays payments, and creates the exact cash flow pressure that you were trying to avoid in the first place. The deposit change also did something we fully didn't anticipate. It became the client filter. Not intentionally, but the clients who moved forward without hesitation were almost always the ones who had done their homework, had their financing in place, and were serious about executing the project. The ones that pushed back the hardest were often the ones that we were glad we didn't sign. The framework that I'd give any builder: don't ask what the industry standard is. Ask what your peak cash exposure is on a typical project before your first major draw comes back in. Model it out. Add it up: early payroll, material deposits, sub commitments, and overhead allocation. And whatever that number is as a percentage of your contract, that's your starting point for your deposit conversation. Build your deposit on structure around your costs, not around somebody else's. Everything I've described so far, the deposit classification, the invisible payables, and the deposit structure, all of it connects back to three financial documents that every business produces and almost no one in construction actually uses to run their business in real time: the P&L, the balance sheet, and your cash position. I want to give you a simple framework for how to read each one, not as an accountant, but as an operator, because these documents are not reporting tools. They're diagnostic tools, and once you learn to use them in that way, the business becomes much harder to fool yourself about. First, the P&L. Did we actually make money on the work that we did? The P&L covers a period of time: a month, a quarter, or a year. It shows you your revenue, the cost of that revenue, your gross profit, your overhead, and your net income. Most builders look at the top line and the bottom line, revenue and income. But the number that matters the most operationally is actually gross profit. What's left after your direct project costs, but before your overhead. That's the number that tells you whether your pricing and your field execution are actually working. Some red flags on the P&L: gross margin shrinking as revenue grows. That's a sign that your pricing isn't keeping up with your costs, or that your cost structure hasn't gotten heavier with your estimates not reflecting it. A year where revenue grew but net profit shrank, which we've experienced directly, is a sign that overhead expanded faster than margin. And any period where you're busier than ever, but the bottom line is flat or declining, is the P&L telling you to stop, look closer, and find out why activity isn't producing the desired outcome. The balance sheet tells us if the business is actually getting stronger. The balance sheet is a snapshot of a single moment in time. It shows what the company owns, what it owes, and what's left over in equity or retained earnings. This is the document that exposed our deposit problem, because deposits sitting in the wrong account don't show up as a liability, they show up as revenue. And suddenly the balance sheet looks stronger than it is. The liability isn't there, the equity looks inflated, and the connection between what you've collected and what you've actually earned gets hidden. The balance sheet is also where accounts payable lives. And if your accounts payable balance doesn't reflect your real committed obligations because you have no PO system creating those entries up front, you're looking at a document that understates what you actually owe. Some red flags for the balance sheet: no customer deposits liability account, or one that's always suspiciously low relative to how many projects you have going on. Accounts payable that spikes unpredictably rather than moving in line with project activity. Retained earnings that aren't growing despite profitable years, which often means that the cash is cycling out through owner's draws or overhead faster than it's being built. and receivables that keep growing, which means revenue is being recognized, but cash isn't coming in. Cash or your cash position can tell you whether the business can breathe right now. Cash is not a financial statement in the traditional sense, but your cash position, meaning your available liquidity relative to your near-term obligations, is the most honest real-time picture of your company's health. The question is never how much is in the account. The question is how much of that is truly available? What's committed against it? What's due out in the next 30 days? And what's delayed that I'm counting on? We started doing cash flow projections weekly when the pressure hit. And once we did, we never stopped because looking at cash weekly completely changed how we make decisions. It told us when to slow down on accepting new projects. It told us when we had real margin to bring on new overhead. It told us when a draw delay was going to create pressure weeks out, giving us time to address it before it became a real crisis. Red flags on cash: bank balance that swings dramatically based on deposit timing rather than operating performance. You regularly feel pressure even when profit looks decent. That is the gap between the reported profit and the available cash, and is almost always a timing or classification problem worth investigating. You're frequently waiting on a draw to pay a vendor or make payroll. Any of these situations is the business telling you that the cash structure needs attention. Here's the simplest version of this framework. Every month, ask 3 specific questions. 1. Did we make money on the work that we did? The P&L answers this. 2. Is the business getting stronger? The balance sheet can answer that. And 3, can we breathe right now? Cash will answer that. If you can only answer the first question, you're flying partially blind. All 3 together give you the full picture. Before we close, I want to address a few things that I hear often that I think lead builders in the wrong direction. My CPA handles all of that. Well, your CPA is a valuable advisor, but they're working with the data that you gave them. And if that data is wrong, their output is wrong as well. Financial accuracy is an operational responsibility before it's an accounting responsibility. Own the inputs. We've always done 10% deposit and it's worked fine. Well, maybe, but work fine and optimized for your business are very different things. If you've never modeled your actual peak cash exposure, you don't know whether your deposit is covering you. You've just been lucky, or you've been quietly financing clients' projects without realizing it. The bank balance looks good, so things must be good. We've covered this over and over again, but it bears repeating. The bank balance has no context. A strong bank balance built on misclassified deposits and unrecognized payables is not strength. It's a temporary illusion. Read all 3 financial documents, not just the ones that feel the most immediate. I'll figure out the financials once we become bigger. The opposite is actually true. The smaller that you are, the more damage a financial blind spot can do to you in the future. A cash crisis at $2 million in revenue is survivable with difficulty. The same crisis at $8 million with a proportionally larger payroll and overhead structure can be fatal. Build the financial discipline early when the stakes are lower and the habits are easier to establish. Here's what I want you to take away from this episode. Financial literacy, or knowing what a P&L is, knowing what a balance sheet is, or knowing how cash flow projections work, is a starting point. It's not an endpoint. Financial accuracy is what actually changes the business, and financial accuracy requires that the data feeding your systems reflects reality. Deposits classified correctly, payables entered at commitment, not at billing, and a deposit structure built around your actual cost exposure, not an industry convention that was never designed for your model. When those things are right, the reports tell the truth. And when the reports tell the truth, you can actually use them. You can see the problems forming before they become crisis. You can make hiring decisions based on real margin instead of a temporarily comfortable bank balance. You can have a real conversation with your lender or CPA because the numbers in front of you actually reflect the business that you're running. I came into this business thinking that my education gave me an advantage. And in some ways it did. But the humbling reality was that a finance degree doesn't protect you from bad data. The education tells you what the instruments mean. The discipline of keeping those instruments accurate is something that you have to build on your own. In the next episode, we're going to go one level deeper into a system that probably changed our company more than any other single financial tool, and that is job costing. Because understanding the company at the top level is powerful, but learning to see exactly which individual jobs are making or losing money and why is where the real operational clarity begins. Thanks for listening to Brickonomics, and I'll see you in the next one.